Hello everyone, welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today we're going to be analyzing McDonald's stock. This one came in by request down in the comments section of several of my other videos. If you have a request you'd like me to take a look at, just ask me and I'll put the ticker on that whiteboard behind me, and eventually I'll make a video for you. The stocks that are not in the S&P 500, those videos I post over on Patreon at the $5 a month tier level. So if you'd like access to those, go join over there, and you will also get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha, and I'll have a link for that down in the description as well. And I will also have a 25% off affiliate link for FastGraphs, which is the graphing service you'll see me use here in this video. It's really useful for these earnings-based analysis like I'm going to use for McDonald's. And I think they have a free trial period that you can use there too. I've been using it for 5 or 6 years now, and it's really nice to sift through stocks and find the ones that kind of fit the profiles that I want to see. And then it's also good, especially for doing these earnings-based analysis and being able to visualize it really quickly. As always, this is not individual investing advice. This is just how I analyze stocks. So, McDonald's. I think a lot of people have been asking me about this one because the stock price is about 20% off its highs recently since the beginning of the year. Yeah, down about 20. Let's see, it peaked at about 300. Now it's at 250. So, yeah. And I think there are like two misconceptions I think that I want to try to focus on in this video. One is that you can't really go wrong with a blue chip business that everybody knows that's done extremely well over the long term. If you invested back in 2004, like 20 years ago, you could have gotten a 13% CAGR over this time, which is extremely good. No doubt about that. Everybody knows McDonald's. And I think and so people think that there's not really a price you can pay that's too much for it. The other which is I think is wrong. Because you can still get very poor returns, which I'm going to show. The other misconception is that it's kind of recession proof because it sells cheaper food. And if you go back and look at 2008, the stock only fell like 15% or something like that, when the rest of the market fell 50%. So people look at that, they think about it, they logically connect those together. They say, well, putting all that together, we can't go wrong, and we're not going to really worry too much about the valuation of McDonald's. So I think those are two kind of myths that I'm going to try to break, hopefully. And so let me show you why. I've only written on McDonald's one other time, back in 2019, almost exactly 5 years ago. So I thought it'd be interesting to go back and look at that. That was a sell article, one of the rare McDonald's sell articles that you'll read. Since then, the S&P 500 is up over 80%. McDonald's is about 18% with dividends about 30%. So it's really underperformed the S&P 500 over the past 5 years. But what I was curious about was to see what my 10-year projections were for McDonald's at the time. I had just invented this full cycle earnings analysis, which is what you'll see me use. A version of it is what you'll see me use in this video. I think I had only been using it for about 3 months when I wrote this article. So it's changed quite a bit since then, but the core of it is still the same. Like this one had a mean reversion. It calculated things slightly differently. But ultimately my 10-year CAGR, which you'll see me use a similar 10-year CAGR in this video, was 0.28% to 1.88%. Now, that didn't really take into account inflation at the time because we hadn't really had much inflation in 2019. We hadn't had the pandemic yet. So I was curious what an inflation-adjusted CAGR McDonald's has produced since this article came out. So I ran the numbers. And what we get here is, let me move my head out of the way. So inflation's been 4.26% annually since then over the past 5 years. McDonald's has been 6.26%. So exactly a 2% real return in McDonald's stock, including dividends, which probably was like just the dividend. I mean, basically you just got the dividend in real terms. Maybe less than that. But anyway, you get a 2% real return, total return from McDonald's over the past 5 years. The high end of my estimate was 1.88% over 10. So, I mean, we're basically on track to what I was estimating then. Now, you'll notice that's not negative. All right, you get a return. It's just not very good, right? So, and we saw with the S&P 500 that it had returned instead of 34%. That didn't even have the dividends in there. So it's probably returned more like 90% since that point. So maybe triple the returns of McDonald's. So there, you can see like valuation matters. You can pay too much and just not get a good return. In terms of the recession proofness of the stock, if we go back on one extra recession to 2000, McDonald's stock fell from 1999 to the beginning of 2003 off its highs about 75%. So I don't think most people that have been buying McDonald's stock think that's even possible. It's definitely possible. It's happened in the past. Now, I will say McDonald's stock was way more overvalued in 1999 probably than it is now. And they did have some business challenges that they ran into. So, but those things can't, and there eventually was a recession along this period. So when all those things kind of combine together, a stock like McDonald's can lose 3/4 of its value over the course, and think about the time value as well. That took almost 4 years to do. So you wait around 4 years, and you're down 3/4 of your money. When if you would have owned like Berkshire Hathaway or something, you would have been up like double. So there's an opportunity cost as well. So these valuations really, they do matter, and it helps to pay attention to those. Well, let's see if I can get rid of this without screwing anything up here. Okay, so back to the fast graph. So now we're going to move to an actual valuation. I'm going to use the time period from 2016 to 2024. And this is a reasonably fair time period. I think this recession kind of takes what might be an actual recession. We could see kind of even though it was totally COVID related, we know that. But if we do have another recession, they could see earnings decline a little bit, especially in real terms. And then I didn't count this 2014 decline. I mean, you can see they lost 13% earnings in 2014, earnings growth in 2014. So I took that out. I moved it forward. We get these faster years, 15, 16, 19, and then flat, and then kind of a simulated recession, and then a recovery. So I think this is just a fair time period to use. Now, if you look at the fast graph, it's going to measure from this point up to this point, and that's about a 10% earnings growth rate. That doesn't take into account this decline. It also doesn't take into account buybacks. These guys have bought back like 20% of the company during this time. So if you take those buybacks into account, that earnings growth rate drops between 6 to 7%. You can also just look at the net income growth from 2016 through the end of this year, do a CAGR calculation on that, and it comes in that 6-7% range again. So the real earnings growth rate is right in that 6-7%. That's a mature company with a little bit of growth in it. But we have had inflation when you consider that we've had maybe 3% of that is inflation, so maybe they're getting like 3% real growth, earnings growth. Then you kind of can see where those things are at. So let's do the math on that, the earnings math. So I use a 6.68% earnings growth rate assumption over the next 10 years. I also included a debt adjustment. So I bumped their stock price up to $309. The way I got that was I took the difference between, this might be slightly different because I didn't update it for this video and the stock price has fallen a little bit, but the difference between the market cap and the total enterprise value is what I use to see what it would cost to buy the whole business, including any debt obligations, minus any cash. So at least the last time I checked it, this was about 22%. I didn't double check, but it's going to be pretty close. So after I make that adjustment, that gives me an earnings yield of 3.94%. The earnings yield is the PE ratio inverted, so it's the earnings over the price. And then for the price, I'm using that 309. So if I don't, so this is like a 25 PE, and this normal PE is like 21. So instead of 21, I'm treating it closer to 25. All right, so the way I like to think about this is if I bought the whole business for $100, they would earn, the whole business, including the debt minus the cash, all that, they would earn $3.95 that I could keep for myself if I owned that business. And that would grow at 6.68% per year. And what I want to know is how much I would collect over 10 years. I pull the first year forward, so $4.21. I collect that, and then I collect another $4.21 plus 6%. And I want to see after 10 years how much I would collect on my $100. So when I do that, I get $157.24. So in 10 years, I can earn $57.24 on every $100 worth of stock I buy. And what I want to know is what kind of CAGR does that work out to? Well, that works out to about 4.63%. So under 5% for me, for valuation reasons, I would consider it getting close to a sell. So this still looks very overvalued to me. I would say the only thing that maybe could help them, I saw they might be having launching a new franchise like Cosmics or something like that. The Cosmic, I forget the name of it. It's something like that. That could be a new growth driver for them if it works, but it can be difficult to do those type of excuse me, those type of kind of new franchise launches. I think of when Starbucks did Teavana. It's just harder than it sounds. So, but if that was successful, then maybe they grow earnings faster, and then maybe this return gets better. So that's something to keep in mind. This right here is the 3-year cumulative revenue. That matches very close. So you think like 18%, that's about 6% a year. That matches very closely what the annual earnings growth rate assumption is. So I think my assumptions are all pretty good here. I don't think I'm being too overly negative, and the returns just are not likely to be particularly good. So when would I buy? Really, the valuation is the main thing that's wrong with McDonald's, provided they can keep coming in with like 6 to 7% earnings growth. The recession, this is one of the weird situations where, because I used 2008 data, because they didn't really fall too much during that recession in 2008 and 9, their recession buy price is actually a little bit higher than just the pure math would be, like $125 to get a margin of safety. That would be an 8% return here. So really, and I think this might be realistic when you think that people do think McDonald's is pretty safe stock. They are likely to come in to buy it. When it gets down 20%, everybody starts asking me about it. And so that's kind of taken into account, is the fact that people could treat this, investors could treat this as a safe haven during the next recession like they did in 2008, which is where I pulled my recession numbers from. So, but it would still need to get down to about 165 to be a buy, about 35% lower than it is now. And then the pure numbers are 125. Would be the pure with a margin of safety and all that. That's not fair value. Fair value would probably be close to that 165, honestly. So 165 is probably where I'd aim for McDonald's. And I think that's even if earnings kind of falter a little bit. So I think right now they're pretty much flat. So the peak earnings that I used to calculate the recession PE are not going to get any worse than 11.94, and they're just barely above that now. So I probably wouldn't, even if earnings fell off a cliff the next 2 years, I would still probably keep that 165 number. That would probably still be the recession buy price. So that's where I'd be looking. I don't know when the last time it traded down there. Hasn't really gotten, you have to go back to 2020. Let's see. It did hit there, in March 2020. Got all the way down actually to 124. So significantly below that. So, and then before that, you would have had to go back to like 2018. So it's been a while. But if earnings, slow, investors can, most of the investors that have bought this stock the past 3 years don't really have much of a return. So you can imagine if they get down once you get down below these like 2020 levels, anybody that like or 2021 levels, that's like 200. Yeah, once it falls below 200, people could start questioning, I think, what got them originally into the stock if the news is kind of bad. So and that could maybe make it take a dip lower. So that would maybe be when I would be interested in coming in and buying. All right, I hope this helped everybody, give them some context to maybe dispel some myths about McDonald's stock, what's possible, what returns are likely. I think you would have to watch for success of that new franchise if you wanted to get a little more aggressive and buy higher and still get, really good returns. I think a lot of people are just kind of probably owning it for the wrong reasons right now. They're just paying too much, basically, would be what I'd say. If you found this useful, hit the subscribe button, hit the like button, and if you have a request, let me know, and I'll see everybody later. Bye.